This is Macro Horizons, episode 309, Seasons Change, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 3rd. And as we leave the holiday season behind and enter the flu season head-on, we're reminded to wash hands, stay hydrated, and remember, this too shall pass. After all, we've already forgotten COVID. Remember working from home? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there were a variety of events underlying the price action in the Treasury market, which did see 10-year yields drop below 450 for the first time since mid-December. The biggest highlight was obviously the FOMC decision. The Fed chose not to lower rates once again, leaving effective Fed funds at 433. Now, we highlight effective Fed funds at 433 because we continue to see that as functioning as a ceiling for nominal two-year yields, which, at least thus far in 2025, it appears to be holding that position. This has ramifications for the shape of the yield curve because, for all intents and purposes, the curve has devolved into being nothing more than a directional trade. By that, we simply mean that we're either going to see a bull flattener or a bear steepener, the bulk of the price action occurring further out the curve as two-year yields remain anchored in a range between 415 and 433. Now, ultimately, this will break, and we're assuming that this breaks on the downside as it becomes evident that even though the Fed is likely to take off the next couple meetings from rate cuts, rate hikes won't be on the table, and the process toward normalizing policy rates will eventually resume. It's notable that during Powell's press conference, he observed that rates are well above neutral. This is certainly consistent with the most recent SEP and dot plot, which has the longer run dot at 3.0%. All of this suggests that we're at least 100 or 150 basis points above what the Fed defines as neutral monetary policy. The forward ramifications from this are relatively straightforward. In the event that inflation continues to drift back towards the Fed's 2% objective, one should expect that policy rates will be lowered over the course of the next several quarters. Alas, our base case scenario at the moment is that the first rate cut of 2025 doesn't occur until the June FOMC meeting. The logic here is relatively straightforward. First of all, Trump's review of the U.S.'s global trade policy isn't officially due until the 1st of April, which we're interpreting as a logical departure point for any wholesale changes on the tariff front. That being said, the 25% tariffs on Canada and Mexico remain very topical, and as the next couple weeks unfold, the market will have greater context for Trump's agenda in this regard, if nothing else. In terms of changes made to the FOMC statement, the biggest ones occurred in the first paragraph, in which the FOMC effectively took out the active language, implying that the progress on inflation and the progress to rebalance the labor market has slowed or stalled. To some extent, this should have been expected, given the fact that the Fed chose not to cut rates. Now, as we think about the March meeting, it's notable that we will have a updated SEP and dot plot, and that will most likely drive the bulk of the price action. That being said, there's a lot of data between now and the mid-March meeting that will ultimately help both monetary policymakers and the market refine expectations and put a higher confidence interval around whether or not the market believes a March cut will be prudent. Again, our base case is that it won't, but a lot can change in the intermediate period.
Well, we got the January Fed meeting, and as expected, the Fed left rates unchanged, but shifted their characterization of the progress that's been made around inflation, with a nod to the fact that the labor market has generally been holding up okay. The initial response in Treasuries was bearish, keeping with the implication that maybe the Fed doesn't need to cut as much as initially assumed, but that was until Powell's press conference where he affirmed that the Fed still views monetary policy as restrictive, even if less so than it was before 100 basis points worth of cuts, and that the easing bias that was brought into this year was still firmly intact given the lagged impact of monetary policy and the risks that still face the outlook. And coming into this week, we were of the opinion that it was probably going to be a Fed meeting to forget. To look at the net price action on Wednesday with 10-year yields unchanged, and frankly the level of yields over a longer-term time horizon and the shape of the curve, the Fed was successful in leaving the proverbial monetary policy boat unrocked.
And frankly, at this stage in the cycle, that's what monetary policy makers want to see. They want to buy themselves a little time to see what is going to come out of the administration, how that's going to impact the real economy, and ultimately resume the process towards normalization at one point. However, clearly the Fed has an incentive not to normalize too quickly and risk a reacceleration of inflation, particularly at a moment where we know, by and large, that we are going to see headline inflation at a minimum biased a bit higher by the tariffs. Now, within the details of the tariffs, the big question, in our mind at least, is whether or not we're going to see tariffs gradually implemented, or if they'll simply represent a one-time inflationary impulse. In the case of the latter, the one-time inflationary impulse, the Fed will be more apt to quickly look beyond that and characterize it as simply a tax on consumption. However, if Bessent is correct with his gradual proposal and tariffs are increased by, let's call it 2.5% per month until the objectives are achieved, that will, for all intents and purposes, create a floor for realized inflation, which will complicate the Fed's job, especially when we put this in the context of immigration reform, which in and of itself might create pockets of sticky wage inflation, particularly for the low-wage, low-earning sectors that have benefited from an acceleration in wage gains throughout much of the pandemic. In short, some of Trump's key changes are going to extend the risks that the Fed spent much of the last 2 years fighting.
And in terms of how this is translated through to investor sentiment, frankly, the conviction among most of the clients we speak to is fairly light at this stage. Given the dynamic on the one hand around a Fed that's content to keep things as they are, and on the other, the uncertainty presented by not only tariff policy, but also the broader fiscal agenda, it's difficult for many to get excited about either buying or selling treasuries at these levels. And so what this is translated to is investors taking a bit of a backseat and a longer-term outlook on the global economy. Namely, the fact that while the U.S. economy is holding up relatively well, that is not universally the case in every country, and even if the Fed is content to continue pushing out rate cuts, we got a cut from the BOC and the ECB this week, which is a reminder that on a global scale, policy rates are continuing their path lower. Combine that with the distribution of risks facing the domestic economy looking out over the balance of this year, and we'll argue the bias at this stage is more of a dip buying than rally selling one, but nonetheless it seems to start the year that patience and not rushing into the market too early seems to be the unifying theme.
One aspect of the price action that has been somewhat surprising has been the shape of the yield curve. All else being equal, we would have anticipated a grind steeper, particularly in 2s10s. The fact that we have seen a flattener as the go-to response in a rally speaks to the fact that monetary policy expectations remain stable, or at least, as you point out, Ben, there's not a great deal of conviction with 2-year yields fluctuating between 4.15 and 4.33. While we maintain that the Fed will eventually resume cutting rates, the reality is that that's an active debate among many market participants. We've certainly heard an increase in calls for no cuts, or even potentially entertaining the notion that rate hikes would eventually be back on the table. Now, this certainly is not our base case scenario, although with a nod to the price action itself, there does seem to be a lot of conversations around precisely what the Fed will or will not be able to achieve in terms of lowering rates over the course of the next year or year and a half. There's also an argument that nominal 2-year yields have been sticky on the upside because of issuance concerns as we look toward the balance of the year and the prospects for the Treasury Department needing to fund an ever-increasing deficit. Now, some of Trump's initial overtures in terms of restraining federal spending, I think, have served as something of an offset to those ever-growing deficit concerns. Another observation worth noting is that there has been a lot of chatter about the potential for Bessent to attempt to term out the Treasury Department's borrowing profile. A lot of this stems from comments that he made prior to becoming Treasury Secretary, specifically that if he had been in Yellen's shoes at that stage in the cycle, he would have focused more on longer-term borrowing. Now, we're certainly sympathetic to taking that logic and saying, oh, this simply means that he's going to increase 10s, 20s, and 30s once auction sizes begin increasing, presumably in the latter part of this year. However, there's a different interpretation that we'll offer. Specifically, what Bessent was doing was he was suggesting that he would have been pragmatic in taking advantage of the lower yields offered further out the curve at that moment. Right now, the lowest yields can be found in the build market and in the 2-year sector. So with an upward sloping yield curve, that suggests that incentive to term out the Treasury's borrowing is much lower than Bessent might have viewed it had he been in Yellen's shoes at that point in the cycle. Just food for thought as the yield curve continues to fluctuate around 30 basis points.
And this also resonates from a demand perspective, given the simple fact that overnight rates, bill yields, and even 2-year notes are still at much, much higher yields than they have been for the bulk of the last decade. So in thinking about asset allocation and the pursuit of returns, it's not unreasonable to make the argument, especially with equity valuations where they are, that the ability to capture a risk-free return of 4 or 4.5% over the next 2 years is not such a bad deal. And this means that as the new Treasury Department looks to tap in to demand for Treasury securities to fund the deficit, that the front end is not a bad place to look, especially after we've seen term premium re-enter the long end of the curve and the reaction function that you touched on earlier, Ian, which is bull flattening and bear steepening. As we wait for the first refunding announcement under the new administration next week, we'll be eager to see any guidance that might be offered on issuance plans over the course of the rest of the year.
Further complicating these dynamics is the fact that the debt ceiling has been reached and the Treasury Department is now implementing extraordinary measures. It's notable that the TGA will now be run down at a moment when the Fed is still actively engaged in QT. Said differently, the Treasury Department is doing QE at a moment when the Fed is doing QT. As we have seen in prior episodes, we expect that this will reverse sometime in the middle of the year, and we will, for all intents and purposes, have a turbocharged QT during the second half of the year as the TGA is replenished and QT continues apace. So, said differently, monetary policy, at least in the near term, might be slightly less restrictive than it might otherwise appear. This comes at a particular time, as it were, for both monetary policy as well as for Trump's initial actions in the White House. While it's tempting to suggest that this is a rare dynamic, we're not 100% sure that that's the case. But nonetheless, we will note that both Trump and Powell have the same incentive as it relates to risk assets and equity valuations at the moment. Given that the trade war and the potential reflationary impact has limited the Fed's ability to cut policy rates from here, a continued run-up in equity prices will contribute to easier financial conditions, with the market then doing some of the heavy lifting for Powell, as it were. From Trump's perspective, the perception is that he views the performance of the equity market as a barometer of his performance in the White House. It will be interesting to see if at any point later in the year there's a correction in equities and we see a shifting of those opinions, either from Powell or from Trump.
And the performance of risk assets was put on display to start the week, obviously, with the wobbles in tech resulting from the AI news out of China, triggering a temporary sell-off in domestic equity indices. And a lot of the conversations we've had around that move centered on two dynamics. First, and more immediately relevant, would a large drawdown in some of the benchmark growth stocks that have come to define this cycle be enough to trigger a dovish reaction from the Fed? The short answer is, if it was severe enough, and we didn't even come close to that this week, the reality is that risk assets continue to offer an easing impulse to overall financial conditions, even as the Fed is endeavoring to keep monetary policy restrictive. That's on the one hand, and probably more relevant from a trading point of view, but from a higher level, the developments out of China and the potential for even cheaper advancement in terms of artificial intelligence is the latest example of what is one of our core tenets around the longer-term path of R* and ultimately Treasury yields, namely that the decades-long trend of disinflation and higher labor productivity is now going to increasingly start to see the impact of AI, and cheaper AI means cheaper increases to labor productivity. Cheaper increases to labor productivity is ultimately going to be disinflationary, and while the pandemic, along with the global trend of a bit more protectionist lean both in the US and around the world, might argue for a marginally higher R*, technological advancements and increased labor productivity are ultimately going to exert a drag on the longer-term levels of interest rates. Now, does that materialize in the March SEP? Probably unlikely, but something we're considering as we watch 10-year yields hold this increasingly well-entrenched trading range.
Well, one thing is clear, Ben. There's no artificial intelligence here.
In fact, there was no intelligence harmed in the making of this podcast.
In the week ahead, the Treasury market will have the benefit of fundamental inputs from which to derive trading direction. The biggest one, obviously, will be the January payrolls report. Expectations are for headline payrolls to have increased 165,000, not a dramatic gain, but nonetheless moving in a positive direction. The unemployment rate is seen at 4.2%, and let us not forget that this report will contain the benchmark revisions. They come out annually with the January data released in early February, and expectations for this round are that we will see prior NFP prints revised lower by 675 to 700,000 jobs. Now, keep in mind that the reference period is April 2023 to March 2024. So it is relatively dated information, although it's relevant in framing how restrictive monetary policy was at that moment. Historically, the benchmark revisions haven't been a big driver of price action, although we're certainly open to it being more impactful during this round, simply because of the questions about where neutral policy rates are, and perhaps more importantly, some of the ramifications from the influx in immigration seen during the reference period. One of the biggest debates at the moment is the degree to which headline payrolls were distorted higher over the course of the last couple of years based on immigration. This is especially relevant in the context of the Trump administration's immigration reform efforts, as that implies lower headline payrolls growth and potentially a round of scarcity for frontline service sector, low-wage, low-skilled workers. That could create a stickier nominal wage environment and contribute to concerns of a wage inflation spiral comparable to those concerns that were in place during the peak of the run-up in inflation. All that being said, we expect that the takeaway from the combination of January's payroll figures as well as the annual revisions will be a slightly less resilient labor market than previously assumed. Let us not forget, we also have the JOLTS data for December. With a quits rate hovering at about 2%, it will be very interesting to see the evolution in the breakdown of the quits rate between private employees and government employees. Now, clearly, the recent efforts by the Trump administration to push back against government employees won't be reflected in the December data. We'll probably see that in the series for January or February or beyond. But in general terms, the quits rate for government employees tends to be much lower than the overall number, so it will be very interesting to see how this particular sector of the labor force responds to some of Trump's initiatives. Let us not forget that on Wednesday, we also have the refunding announcement where we're expecting $58 billion 3 years, $42 billion 10 years, and $25 billion 30 years. All of these are very consistent auction sizes, and we're not anticipating any broad-based increases in borrowing needs until we're well into the second half of the year. Keep in mind that the Treasury Department has already begun implementing extraordinary measures as we are now up against the debt ceiling. Even with this backdrop, it is notable that the Fed is continuing to allow the balance sheet to run off in the background, a dynamic that we expect will actually remain in place throughout the bulk of certainly the first half, if not into the third or fourth quarter of this year. When asked specifically about QT, Powell observed that there hasn't been any clear signs of strain in the funding market. All of this implies that the Fed might be approaching the decision regarding QT from a reactive as opposed to a proactive perspective, meaning that once they start to see signs of stress or strain in the funding market, it's at that point where they'll start to scale back QT. It goes without saying that this is an open question and one that we expect will be especially important in the funding and the swaps market over the course of the year. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with the DeepSeek drama highlighting the race for artificial intelligence, we'll be the first to admit that at this stage, we'll take any kind of intelligence that we can get. Although, frankly, we probably wouldn't know what to do with it. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.